Hey everyone, it's Sean from Guaranteed Rate. We got a mid-October 2021 market update. Lots of good stuff to cover. We're going to talk about the jobs report and the impact it's having on interest rates. We're going to talk about mortgage application data, both on purchases and refinances, and some trends we're seeing. We're going to talk about home buyer trends that we're seeing, the Great Reshuffling, and what an Exurb is. So first and foremost, huge weekend here in Boston. Patriots won, beat the Houston Texans. The Red Sox, two walk-off games back to back, and that's after beating the Yankees in a wild card game. So all is good here in Boston. Um, Selfishly, I'm hoping for the White Sox to beat the Astros. I would love nothing more than see a Red Sox, White Sox, Boston going to Guaranteed Rate Field in Chicago and pulling off a win there. I think would be really fun for me. I might even make the trip. So, and obviously thank you and congratulations to everybody that ran the Boston Marathon yesterday. Obviously not only is it an amazing accomplishment, and you should be absolutely proud of yourself if you did it. And the city should be proud of itself for a great event to put on. But also thank you to everybody that raised millions of dollars for charities all across the state, the city, and across the country. Just an awesome day. And thank you, lastly, before we go on, to every single person out there that's trusted us with their clients all across the country. So if you guys don't know, but hopefully you do, we're licensed in all 50 states now. We have been for the entire year. We've done an amazing amount of business all across the country, and I'm so appreciative. We're helping with refinances and purchases on any residential property in the U.S., no matter what state it's in. And we've gotten referrals from realtors with their clients relocating. We've gotten referrals from financial advisors with their clients all over the country, whether it's purchasing or refinancing. Our clients are referring us their friends and their family. And then lastly, tons of business from loan officers from all across the country at different companies that aren't licensed in certain states, trusting us with their clients to deliver the same kind of excellent service they would normally deliver. So we're focused and motivated to have a super efficient process, high level of customer service and satisfaction. And we are just going to keep getting better at that. But thank you guys. I wanted to take a minute and say how much I appreciate it. So first and foremost, big news on Friday. The jobs report is always something we try to report on, and it ties together with the Fed's actions in terms of interest rates. So the September employment numbers in general disappointed, right? So the headline number, only 194,000 jobs created versus the 500,000 jobs that were expected. Okay, so much, much lower than was anticipated. Obviously not a good thing, way, way low. So, but mortgage rates are actually on their way up because of the other information in that same jobs report. So the headline number was bad, but we'll talk to you about some of the good information in there. So here's some of the information from the report. Biggest job declines were in government jobs. Government jobs across the country lost about 123,000 jobs in September. Private payrolls, however, gained 317,000 jobs. So that was overall good. The private sectors are hiring. Leisure and hospitality, so the hotel business, restaurants, the sector most heavily hit by the pandemic, only gained about 74,000 jobs in the month of September, so that was low. Despite poorer gains in September, August non-farm payrolls were actually revised upwardly from only 235,000 jobs in the month of August. That's what they initially reported, but it was actually ended up being 366,000 jobs. So overall, good news built in there as well. Another perceived good data point, the unemployment rate actually dropped from 5.1% down to 4.8%, so under that 5% threshold that they were looking to get under. Most attribute this actually to a drop in the participation rate. So as potential workers remove themselves from the workforce after unemployment benefits have ended that were a part of the federal stimulus. But a drop in that rate below 5%, 4.8%, was interpreted as more good news. September also saw a rise in wage growth. So that was up 0.6% month over month, as employers are just forced to pay higher wages because there's a smaller workforce and there's a labor shortage. In order to try to incent and motivate people to work, they're paying them more money. This is also perceived as good news, as more income across the country will go back into the economy. Some other data points, that were interpreted as good news built into this report. 5 million people said the pandemic prevented them from working. Okay, so obviously that's a lot of people. However, the previous month, it was 5.6 million people said the pandemic prevented them from working. And then 1.1 million people reported they were temporarily laid off. At the height of the pandemic last year, that was 18 million people said they were temporarily laid off. So to go all the way from 18 million people down to 1.1 million, was interpreted as good news. As a reminder, the unemployment rate had surged from 3% to 15%. Now it's back under 5%. So all these things are perceived as good news. With the inflation rate, however, more than double the Fed's target rate of 2%, market participants actually generally expect the Fed to lay out its plan to begin removing pandemic-related Fed accommodations as soon as November. Interest rate future markets are predicting the first Fed rate increase actually 1 year from now. Despite soaring inflation, the labor market is still tracking well below the Fed's goal of full employment. Non-farm, like I said, under 200,000 in September, believe non-farm payrolls growth of less than 200,000, some believe would likely cause the Fed to postpone their plans to taper bond purchases next month. But with the upwards revisions in August and some of that other good news I listed off on there, the market consensus is that the Fed is going to continue with move forward with tapering. So they're going to pull back on some of that bond buying, as we've talked about in the past. They're buying, anywhere between $100 billion to $120 billion in mortgage-backed securities and treasuries. As they pull that back, they're the biggest buyer in the game. Rates will go up. So we've reported a couple weeks back of the Fed meeting minutes where they talked about some of this and what their plans were in the future to kind of signal that rates are on the rise. Mortgage rates have actually increased 0.25% since then, since the last Fed meeting minutes were released in September. Rates are actually at the highest rate. We've seen the highest 30-year fixed rates in actually about 3 months right now. So rates are still amazing. They're up 0.25%. What this means in practicality, right? So our average loan size here on our team is slightly over $500,000. Okay, so with a 0.25% rate increase, that means our average borrower their payments have increased about $75 to $80 a month in the last in the last month or so. Okay, they've lost about $15,000 in buying power. Now, rates are still amazing. Okay, we're still seeing rates in some cases high twos, in most cases right around 3% or higher. Okay, that's not going to slow down our market. Okay, the market can easily withstand a payment increase of $75 a month, $80 a month, or a loss of $15,000 in buying power. The reasons why, we've talked about income numbers increasing. Certain sectors are doing better than ever. Clients have actually saved up a lot of money, as last year there was less travel, less spending, so more debt's been paid down, less debt out there, and more savings to utilize towards down payments and things like that. On top of that, we're seeing less bidding wars. There's a little bit more inventory. So we're not seeing the crazy bidding wars of the spring and early summer in this market. We're actually seeing clients actually get more offers being accepted. So we're actually seeing a little buyer optimism out there right now. So rates are going to rise. We're predicting rates to rise. A suggestion we're giving to our clients right now, if you're happy with your rate, you're happy with your payment, secure the rate. Don't try to gamble with the markets. It's tough. There's a lot of volatility. It can be very stressful. We do in general expect right now through the end of the year for rates to continue to rise based on the Fed's activities, some of the inflation data, the improving employment numbers or perceived improving employment numbers. So the advice we're giving right now is secure your rates and protect yourselves. What's gone on with rates, to kind of give you guys an 18-month preview, rates plummeted last year at the beginning of 2020 when the pandemic forced shutdowns and whatnot. Massive uncertainty in the markets. Unemployment numbers spiked, stock market tumbled. There was massive uncertainty in certain sectors, and rates remained super low through that. Then rates started to rise. They started to rise when there was news of vaccines, there was government spending. They were starting to trend back upwards, and then the Delta variant happened, and rates plummeted again. And we went back down to all-time lows. Now there's lots of taper talk by the Fed. There's falling case counts as the vaccine's been broadly distributed. I do think you're going to see the case counts bump up again around Thanksgiving and Christmas and the holidays, like it happened last year. So we might have a little bit of a pullback during that time. We'll see. But in general, based on the Fed's activities and all the information we just covered, we do expect rates to rise. Now, I don't think we're going to see a sharp rate increase, and I don't think it's going to go straight in one direction. There'll be market volatility, but that's kind of a brief overview of what's happened over the last 18 months. Here's how things are being impacted in the purchase and refinance market. So mortgage application data, pending home sales, which measures signed contracts on existing homes, they were jumped up 8%. This was much stronger than the 1% expected. So good news there. Year-over-year contracts are down 8%, which is pretty decent considering how low the inventory is and how much prices surged. Okay, and also a tough comparison because last year was so hot. Remember last year the motivation to move and the surge to move and move immediately was so strong. Okay, rising inventory and less price pressure we just talked about is accounting for the surge. There's a little bit more hope and optimism from a buyer standpoint and more options available. So, of course, you're going to see more sales. Bottom line, if there was more homes for sale, you'd see more sales data. There's lots of strong buyers out there, very qualified borrowers that are ready to go. They just have to find a house and they have to win the bid. And we can help with that, by the way. Mortgage applications to purchase a home are down 1.7% last week. Year over year, purchase applications are still down 12.6%. Two reasons purchase applications are down this year, year over year. One is the rise of the cash buyer. The cash buyers are accounting for about 22% of deals all across the country right now. And then the lack of inventory, as we've been saying all along. If somebody applies for a mortgage when they think there's hope to buy a house, or they see something they like. If they don't think there's hope to buy a house, or they don't see anything they like, then they don't apply for a mortgage, right? Refinances were down 9.6% last week, which was expected, as we saw about a 0.25% bump in rates. Every time rates tick up an eighth, there's less and less clients that are eligible to refinance. Although don't let that prevent you from applying for a refi. If there's still some amazing rates and amazing opportunities right now, with rates being still pretty amazing and plenty of equity out there. Two things that we're seeing right now, two things that have been really jumping out at me over the last 2 weeks for client opportunities that I want to make you aware of. One, cash out refinancers are as strong as I ever remember them being. There's more equity in homes than there ever has been in this country. So we're seeing a lot of clients cash out their homes, especially for home improvement projects, and that ties into the lack of inventory. Rather than buying something and paying these increased prices, people are staying put and renovating their homes and doing major projects, redoing kitchens, redoing bathrooms, adding bedrooms, adding additions, and rather than moving and participating in this tough housing market, they're staying put and reinvesting the money in their house, which they hopefully bought at lower prices in the past. So cash out refinances are surging. Also, borrowing costs is cheap, so you can borrow that, take that money out of your home, and use your equity at the cheapest rates some of all time. So that's one thing. The other thing we're seeing is adjustable rate mortgages. If you're a client that currently has an adjustable rate mortgage, trust me on this one, you should reevaluate your mortgage and look at redoing it into possibly another adjustable rate mortgage. We're having a lot of success with that right now. Adjustable rate mortgage rates are some of the best we've ever seen in my career. The benefits of it is, one, obviously you can lower your rate, save some money. The other benefit is you can give yourself a little bit more security. If you took out a 7-year ARM as an example a couple of years ago, you can get a fresh 7 years, so you get added 2 years more protection, lower rate, lower payment. We're giving all our clients the options to do these with and without closing costs. So a lot of times you can have the lender give you a credit to offset your closing costs. So you just got to invest the time to find out this information and participate in the application, documentation collection, doing a reappraisal on your house, all those type of things. But massive opportunity there. Now, obviously, there's plenty of other reasons to refinance, eliminate PMI, shorten your term. We're doing all those things. I'm blown away every single day by the opportunities out there for our clients. So definitely, there's no cost, there's no obligation. It's purely informational. If you haven't refinanced yet, even if you have, you should be try to figure out what's out there right now in comparison to what you have. It should be a short phone call. And lastly, we're going to talk about the Great Reshuffling. Our friends over at Zillow have dubbed their article "The Great Reshuffling" as homeowners working from home have paused and reevaluated how and where they want to live. Now, as employers make decisions whether or not to reopen workplaces this fall, a new Zillow report suggests there's more reshuffling to come. So here's why. Research found the following: 39% of workers in the U.S. still don't know if they'll be going back to the office at all, or they're going to remain remote or in a hybrid situation. 35% of the uncertainty is impacting life decisions. So including moving, right? Uncertainty, a lot of times people freeze, right? 84% of those surveyed said they would like to work remotely as a few days a week or a few days a month. And then 44% want to work from home 100% of the time, okay? So obviously life's changed. Obviously we know that a lot of employers still haven't made decisions, or they've changed their decisions as some of the information and data's has been coming out. So with supply and demand issues continuing to drive up home prices, remote work has the potential to bring the most significant expansion of economic opportunity and housing affordability witnessed in a generation or more. Okay, remote work will be a significant driver of housing demands for years to come, along with demographic trends. So I learned a new word. So the trend to watch, the exurbs, so the extended suburbs or the outer suburbs. So over the past year, the outer suburbs, or exurbs, if you will, have experienced a particular intense boom. Okay, so it's distant areas which saw the sharpest increase in interested buyers and home price appreciation, according to Realtor.com. So as an example, if Boston is a city, a suburb would be a town like Weymouth, and an exurb or an outer suburb would be a town like Plymouth, about an hour or more away from the city, depending on traffic, right? Farther from the big cities, the land is much cheaper. There's more land available. There's more space to build. There's more space to quarantine comfortably and have all the amenities that you need in a new environment, especially if you're remote working, right? And don't have to obviously need the office space at home where your family is, but also not having to commute as much to work anymore, or half the time. And bottom line is they're more affordable to homeowners, right? So builders have taken notice of this. Investors have taken notice of this. Construction on new homes in these markets is booming. There's also investors seeking options to flip these homes, or also keep them, buy them, and rent them out to people that also aren't going to buy yet but want to rent in those areas. How long will prices continue to rise in these exurbs? It's tough to say. Increasing the number of exurb homes and residents in turn attract commerce, restaurants, shops, stores, all those amenities move to meet the needs of the people living there. And that as those amenities become more and more available, more and more people become attracted to going to those markets. So it's kind of self-fulfilling. So as long as supply does not start outweighing demand, those markets are going to remain hot. We're seeing that from our clients talking to us as they talk to us about where they want to live. So a lot of information, try to keep it concise. I'll see you guys in a couple weeks, or hope maybe even later on this week if some more information data comes out. Go Sox. Talk soon, guys.